Hey, good evening. It's Ralph Mendez. We're going to work on our homework here. Chapter 3, Adjust and Entries. And see if I can do this one more time. What is the role of depreciation on the company's equipment, prepaid insurance, office supplies, 1/5 of the work done, wage expense? What are adjust and entries? Well, let's think about it. An income statement, a company shipped goods on credit, and the company's sales invoice is not processed yet at the end of the period. So you need to create invoices. A company receives some goods from a vendor, but the vendor's invoice has not been processed. So you owe them, but maybe you need to enter it in your records. You paid insurance. Let's just say a company prepares monthly income statements paid for 6 months of insurance. So you got to make an adjustment for what you used each month for 6 months. A company's customer paid in advance for service to be provided over several accounting periods. Until the service is provided, the unearned account is reported as a liability. And then if you've done the work, then you've reduced the liability. So think about it. Who bills at the end of the month? City Public Service. So the company sends you an invoice after you've been using the electricity all month. Your water bill, they send you a water bill after you've been using it. You don't pay in advance. Cell phone, they send you a bill based on your usage and consumption. So there's all kind of adjustments you have to do. Otherwise, your financials are not going to be accurate. In this case, depreciation is the cost recovery of the depreciation of company's equipment for years computed to be 14,000. So later on in a later chapter, we'll solve that for you. But right now, you just have to make the adjustment for how much the depreciation is. And the credit is accumulated depreciation equipment. There's an expense, and this is a contra asset on the balance sheet. It offsets the asset of equipment. The prepaid insurance. So here's where you paid insurance in advance, $7,000 at December 31st before adjusting the cost. An analysis of the company's insurance show that $1,500 of unexpired remains. So unexpired means that's still an asset. It's still to be used for the next period. So if you had 7,000 and there's only 1,550 left for the next period, how much should you use? You have to subtract them. And your prepaid, which is an asset, goes down on the right side, credit, and expenses all go up on the left. Okay. So the office supplies had a 440 debit at the beginning, and 2860 were purchased, 2680. The physical count showed 519. So let's take a look at this a little bit more. You had supplies of how much? You had supplies at 440. 440, and then you buy more, 2680. So that makes it go up again. But then it says you only have how much left? 519. So there's only 519 is the balance. So if you had 3120, how much did you use to end up with 519? So 440 plus the 2680 is equal to 3120 minus the 519 means you use 2601. And if you used it, it's become an expense. So 2601 has become an expense of the supplies. The supplies expense goes up with a debit, and the supplies, the asset, goes down with a credit. What else is going on? 1/5 of the work related to 10,000 cash received in advance was performed this period. So 1/5 is $2,000. $2,000 of the work was received in advance. So the unearned revenue goes down, the liability goes down on the left, and it becomes revenue on the right side. So the revenue is going up and the liability is going down. The prepaid rent account had 75. $5,700 debit before adjusting for the cost that expired. An analysis of the rental agreement shows that $1,450 had expired. So they're telling us that the expense is $4,150. So rent expenses go up on the left side, and prepaid rent is going down the asset. All right. Now, $5,700 of prepaid rent. So right here, $5,700 of prepaid rent, and it's telling us $4,150 has expired. So that means expired means $4,150. So what's left is this minus this. So what's left is $1,550. But when it tells us how much is gone, then that becomes the rent expense. So expense goes up on the left side and the asset goes down on the right side. All right, let's see, one more. Wage expense of $200 has been incurred, but not paid. What does that mean, incurred? That's a hard thing for people. What does incurred mean? You owe wage expense, you owe expenses of $2,000. So that means to become liable or subject to. So you're liable, you owe someone. So when you use your electricity all month, you've incurred electrical expense. When you use the water all month, you've incurred water expense. When you use your cell phone all month, you have incurred expense. You're liable to those companies. You have incurred expenses. But the way you say it here is you incurred expenses by using employees, and then you have a wage payable. Record the depreciation, record the insurance expense, supplies expense. Your liabilities go down if you did some work. What was your rent expense? What's your wage expense? So these are all examples of adjustments done at the end of a period, and they make your financials more accurate. You have 6 employees, you earn $105 a day. So how much is that per day? $630. They are paid on Fridays for work completed Monday through Friday of the same week. Near year end, the 6 employees work Monday, December 31st, and Wednesday through Friday, January 2nd, 3rd, and 4th. New Year's Day was an unpaid holiday. Prepare the journal entry for wage expense and record the payment. So first thing to do is you have to get 1 day of pay into December. You don't want December's expenses in January. So for that 1 day, Monday, December 31st, how much is it we owe? 6 people, $105. So on that day, you put $630, and it's a wage expense, goes in December, and wage payable. Why is it a wage payable? Well, it may be Monday, but you're not going to pay them on Monday. You pay them on Friday. Now, on Friday, how much is your wage expense? You have to pay them for that Monday, and you got to give them cash. Oh, and it's how much here? That was 630. I'm sorry, 630 payable, but you owe 3 more days, January 2nd, 3rd, and 4th. So 3 days, 16, what is that, 1890? All right. And then, so that's how much cash you got to give them. You got to give them for 4 days. So 24, 25, 20. Okay. So on December, you got to record that 1 day that belongs in December. And then the other 3 days go into January. So you don't want December expenses in January. Okay. That's the way why you make adjustments to put it proper, to match the expenses and revenue in the proper period where they belong. On April 1st, the company hired an attorney for a monthly fee of $2,000. Payment for April legal service was made by the company on May 12th. On April 1st, the company hired an attorney for a flat monthly fee of $2,000. Payment for April legal service was made by the company on May 12th. Prepare the adjusted entry if any. So we owe someone. So at the end of the month, you have legal expense, legal service expense, legal services payable. So because you hired him on April 1st or whatever, and at the end of the month, you haven't paid him, but you got to put it on your books. You're making sure that expense belongs in April or May. It belongs in April, so you make an adjustment to reflect that. Remember, you record the transactions to properly reflect what's happening in your organization. Record the payment. Well, the payment is legal services payable goes down in cash. So 2000. So, but over here, you put the expense into April, but even though you pay them in May, you want the expense to go in April. As of April 30th, 968 of interest expense had accrued, which means you owe $968 on some money you borrowed. The full interest is not due till May 20th. Prepare the recording entry. So right there, you have to put that you owe this interest. It's interest payable. You got to pay them next month in May. Interest payable. Well, what is it for this month? So interest expense. Let's just say you borrowed money from somebody who says, well, I want $1 a day interest expense. Well, at the end of the month, you owe $30. And the next month, you owe $30. Regardless of when you pay it, you've got to book it that you owe that money. What is here? Let's see. All right, so now what do they want? The full interest. So here, they want you to pay the whole thing. So 2905 is the total amount. 968. Oh, well, what happened there? Interest payable. 968. And the difference is interest expense for the month of May. Interest expense. 2905 minus 968. 1937. They got it match up. 28. 2905. All right. Total weekly salaries expense for all employees is $9,000. The amount is paid at the end of the day on Friday for each 5-day work week. April 30th falls on Tuesday, which means the employees had worked 2 days since the last payday. The next is May the 3rd. Prepare the adjust entry, if any. So they're $9,000 for a 5-day work week. It's 1,800. So there's 2 days we have to book on Tuesday, the end of the month. So April 30th falls on Tuesday. So this is April 29th, and for 30th, we owe 2 days. So it's wage expense. Can't find the topic here. Wage expense. Oh, they put salaries. Salaries payable. There you go. And then what happens here? Well, here you got to pay the salaries cash. And for the whole week, it's 9,000. But 3,600 of it was for 2 days. And then 5,400 is for the other days. So this is the wage expense for the other 3 days. For the other 3 days. And then you get rid of the salaries payable for the 2 days. So they got to add up 53 and 36 at 9,000. You got to give them cash. Legal expense, you owe incurred. Then you actually give the cash 12 days later. Put the interest in April, then you don't pay the interest till 20 days later. So there's the interest for the month of April. There's the interest for the month of May. Accrue the salaries you owe, even though it's Monday, Tuesdays, you pay on Friday for even Monday, Tuesday, and then Wednesday, Thursday, Friday. This way you put those 2 days in April and these 3 days in May where they belong. All right. So over and over, you're doing adjusted entries. So you got a lot of practice to do. Wages are earned by workers, but not paid on New Year's Eve. So that means the company has wage expense and it has a liability. It owes these workers $10,000. In this way, you're putting it on their books. You're recording the transaction that occurred. Depreciation is 1168. It's not, you're not having to calculate it. Later on, you can learn how to calculate it. So it's an expense. And you keep track of it as accumulated depreciation. And you're getting to recover what you paid, but here you keep track of how much you recovered. The word accumulated tells you, gives you a hint. Hey, we keep track of how much we've recovered. The office supplies had 370 and 5125 is purchased. You had 370, 5125 is purchased. So now we have 5495. Well, what happened? A physical count shows 563 or left. So when we count them, we only count 563. So how much got used or gone? How much is gone? 370 plus 5125 is 5495 minus 563. 4932 is gone. And if it's gone, it got used, and that's the expense. 4932 is what your supplies is gone. And what did they become? If they got used, they became a supplies expense, and the asset is going down. Okay. The prepaid insurance has a 5,000 balance at the beginning. An analysis of insurance policy shows 2,700 of it unexpired. So the way prepaid insurance, you had 5,000 and 2,700 unexpired means that's the balance down here. So what's gone or expired is over here. It becomes an expense. So 5,000 minus 2,700 is 2,300. So the amount of expired insurance is 2,300. And the way you say it expired is you call it insurance expense. And your prepaid, the asset is going down. The company has earned but not recorded $550 of interest revenue for the year ended. The interest payment was received on January 10th. So you have to put on your books and records to accurately reflect the fact that you have interest revenue, so that, and you're not going to get paid for a few more days. So it's interest receivable. You're going to receive. Let the word help you. Interest we're going to receive because we have earned it. And interest revenue is like rent on your money. The company has a bank loan and has incurred but not recorded interest expense of $3,000 for the year. You're going to pay it next year. So, but you have to tell the world that you owe $3,000. So interest expense. So you do the accrual. Interest expense. No pop-up window. Interest expense, interest payable. All right, so let's check our work. What I just put 500. Can't talk and type at the same time. Okay, good job. I hope this helps you. And then there's a couple more parts for this chapter. All right, thank you very much.